Elliott Wave Analysis, a powerful tool for market analysis. Welcome back to the channel. Today we're diving into Elliott Wave Theory, a powerful tool for market analysis. Let's get started. Elliott Wave Theory suggests that market price unfolds in specific patterns called waves, reflecting investor psychology. There are two main types of waves: impulsive waves and corrective waves. Impulsive waves are the main movements in the trend directing and consist of 5 waves. Wave 1, the market moves up as some investors begin to feel optimistic. Wave 2, the market corrects slightly as some investors take profits, but it doesn't retrace the entire wave 1. Wave 3, this is usually the strongest and longest wave, where the market moves up significantly as more investors jump in. Wave 4, a major correction that is typically less intense than wave 2. Wave 5, the final push upward, fueled by the remaining bullish sentiment. After the 5-wave impulse, the market enters a corrective phase, composed of 3 waves, A, B, and C. Wave A, the market starts to move down as initial profit take occurs. Wave B, a small upward correction as some investors buy the dip. Wave C, a final move downwards, completing the correction. Let's look at practical example with Bitcoin. Suppose we've identified a 5-wave impulse pattern. This suggests that after wave 5, we might expect a corrective ABC pattern. Recognizing these patterns can help us make informed decisions, like when to enter or exit trades, or when to hold through corrections. To sum up, Elliott Wave Theory offers a structured way to interpret market movements and investors' behavior. By understanding and applying this theory, you can better anticipate market trends and improve our trading strategies. Thanks for watching. If you found this video helpful, hit the like button, subscribe, drop a comment below with your thoughts on Elliott Wave Theory, and let me know what topics would you like to see next. Happy trading and see you in the next one.